Watch Full Disclosure on YouTube and listen to us on NPR, Spotify, Apple, and all of the podcatchers. We put them all at one link, fulldradio.com. Again, fulldradio.com. Please subscribe, rate us, tell your girlfriend, mother-in-law, friends, everybody, and catch me on CNN and NPR's Here and Now. Joining me from the bizarre hinterland that is downtown Brooklyn is Sam Rowe. He is the brain and the brawn and the grit and the sweat and tears behind TKer. It's actually spelled TKer. It's a play on that. This is a investing newsletter for the long term. Sam has a fascinating career, and he was previously at Business Insider, Yahoo Finance, Forbes, Axios. He started his life, just like I did, as a grunt on Wall Street. He claims he was a janitorial level person at a major Wall Street linked law firm, and then he was at Brown Brothers Harriman, and now he is dispensing all of this great wisdom and everything he's learned along the way in TKer. How are you?
I'm great. I'm excited to be here, and thanks for the introduction. Every once in a while, we get to meet with people who come from, some gigantic white shoe financial services or legal firm that gets into media. So I'm always thrilled to be speaking with folks like you.
Well, it's great, actually. I'll say everybody, and I want to get a little hokey with this for our listeners. I've been doing this now for 12 years. And prior to that, I was a print journalist and I did a lot of NPR and TV stuff. It's a hoot for me to actually meet someone on this newfangled platform, kind of post-pandemic, where we're doing video podcasts. I've always admired Sam's byline from afar, some of the work that he's put up there. And to actually meet him, you guys are getting really authentic, fresh-baked, long-form, slow-cooked, small batch content here. I'm meeting Sam in real time, and you get to be a fly on the wall.
Yeah, right. I mean, this is what the world is now. It's untraditional. It's the kind of interaction that is supposed to be saved for the green rooms or whatever. But it turns out that people want to hear about these the background conversations too, I guess.
Well, I'll tell you this. I started off on the sell side right after college. When I graduated in 98, you had to duck to not get a job on Wall Street. I mean, Goldman, Morgan Stanley, Merrill, they take over the in across the front gates of my campus. And one night would be sushi night, fondue night. You didn't know what it was. Just broadly, if you didn't know what the heck you wanted to do with your life, you could go to investment banking. Right. And you end up getting disillusioned once you show up and they give you your laptop and they want you to be a spreadsheet and PowerPoint monkey. But I did learn a heck of a lot in those 2 years of sales and trading and research at Goldman. And I realized, one, in that I hated it, but two, I really wanted to write about what I learned. I really was fascinated, like I gather from your byline, in demystifying these things for mom and pop. Tell me about the genesis of you launching TKer. I mean, clearly you've traveled in many routes. As a student of this, you, like me, were a liberal arts major, and now you're out there speaking directly to the long-term investor.
Yeah, well, I sort of backed into this on accident, and even financial markets and investing, it was all kind of an accident. I graduated from school in 2004, right in that valley between the dot-com bubble and the financial crisis. But this was the upswing, right? And there was work out there. I didn't have a great plan for what I wanted to do, but I spoke to some recruiters and headhunters, and fast forward, I got a job as a contractor for Paul Weiss. This is a law firm in Midtown that, has a lot of banking clients. And through that process, I got my introduction to equity research, everything ranging from how the analysts would speak with each other to how research reports were being drafted. There were two realizations that hit me very quickly. That practical world, the first thing I learned was that there's a lot of art mixed into this science that's called securities analysis. And I really like that in that, I had a little bit of a math background, but I love this sort of intersection between a hard science and something as silly as trying to predict human behavior and how they're going to spend and what they'll buy in the markets and all this kind of stuff. The other side of it was I was broke. I was about as close to broke as possible. Like the job paid well, but I had to get my finances in order because I was paying off student loans and all this stuff. So I also was able to marry that with this idea of financial education, which I never really got. And anything I was exposed to growing up was way over my head. And so in the process of becoming fascinated with this world of finance, I was also learning that, well, gosh, if this was communicated to me in a certain kind of way, I would be in a completely different place right now. And so fast forward, I wanted to get into finance in one way or another. In particular, I was just fascinated by that research world. It's not easy to just make a jump randomly with no finance background into that world. But like you were saying, I was able to get a position in operations at Brown Brothers Harriman, where I was doing work that just doesn't exist anymore, actually. I was part of a team that would receive emails and printouts and faxes with settlement reports, and I would take these things off of the printer and type them into some computer software, and I just had to make sure that the left side of the balance sheet, match the right side of the balance sheet. But that got my foot in the door in that, I got to interact with people. When you're at a firm like that, they do a lot of things like, career training, education. They had classes that they offered.
Did you have to take a Series 7 or Series 63 or anything like that?
No. Like all I had to do was take a drug test. Again, this is that was like in 2006. These were the heady days of that financial markets boom.
Pre-lapsarian, because we really did not know what was coming down the pike.
No, we did not. And so from there, I was able to get my first job writing about markets at Forbes. This was in 2006. I was researching and writing stock picks for investment newsletters that were being published out of Forbes at the time. And my boss, as part of the job, required me to be enrolled in the CFA program, which was something that I wanted to pursue anyway. So it was great that, the company would pay for the classes and everything and reimburse me after I passed. That was the important thing. You don't get paid until you pass these levels. Meanwhile, doing work where it was real world application of this education that I was getting.
Let me ask you, throughout all that, I mean, I guess you were watching CNBC back then when we were cable-centric people and you were in that firmament. In the culture that I was indoctrinated into Wall Street was much more of a stock-picking world. And what I've learned throughout the years, how a river goes on and picks up pebbles and becomes weathered, and over time the bends and turns and everything is a whole part of the river, I guess in my metaphorical mind, is all of the great sources that I've met over the years said, you and I know that so much of this is a marketing machine. Nobody beats the markets. None of these sell side analysts, very few of them actually have this black box or a machine that can beat things. If they do, they go on to make a hedge fund and you're not their audience, right?
Exactly.
They're charging 2 and 20 or even more. And so over time, and I'll say one of your bosses, Henry Blodgett, who I've had on the show, right? Henry Blodgett was the founder of Business Insider. I covered him at the turn of the century as a kind of a overly boisterous sell-side analyst when he was a .com analyst. But in his rehabilitation tour, he wrote a series of articles coming out of the thing that, look, the only way to make money over the long run is to keep costs low, to index, to do all these things. I bring it up to him all the time because in this penitence tour, like I really took note of that. I was like, wow, the more sources you interview, the more you're with people out there, even Warren Buffett and the like. Some of the greatest investors you covered said, set it and forget it. Keep costs low and be agnostic. When did you have that epiphany?
It was probably during my time at Forbes. Which is good. I'm glad I was able to do that so early in my career and so early in my saving and investing career. There was a point where I was convinced I can pick stocks that could beat the market because I knew the fundamental analysis and I had all these tools in front of me, and therefore, gosh, I must be better than the S&P 500. And I ended up buying a series of stocks that were losers. Not only were they losers, they were going down during a bull market, which is a very difficult thing to do. I was that bad at picking winners, not to mention the fact that back then, trading commissions, were a thing for retail investors. So yeah, very quickly I realized that this was not for me. I didn't have the stomach or the mind to do it. But yeah, to your point, when I was working at Business Insider with Henry, this was a thing that we would often write about. It would sometimes get buried behind everything else that we were writing about with everything exciting that's always going on with the markets. But, every study that has ever been done in terms of this world of stock picking and active investing and trying to outperform the benchmark indexes tell you most of the time you underperform. Not only that,
and these are people who are paid to follow markets obsessively. And then even 80% of the time, they can't make the benchmark, what you and I are able to buy for nothing.
Exactly. And the few who do beat the benchmark on any given year or even a 2-year period can't maintain that. So it's like it's basically impossible to do this consistently over time. There's different market dynamics that help us better understand this. But yeah, it's basically, the odds are stacked against you that you're going to pick those right stocks. It's not a matter of 50-50, right? It's not a 50-50 chance that you're going to pick stocks that beat the market. It's close, like depending on the time horizon, it's like you were saying, it's actually closer to 20 to 80, right? Because there's a handful of stocks that generate astronomical returns that end up driving the performance of these big indexes. But yeah, getting back to that, it's funny. I still talk to Henry, and he engages with my newsletter and some of my posts. And every time I write up the study, that gets updated every 6 months, saying that again, more than half of the active mutual fund world is underperforming indexes. He always gives that reshare on LinkedIn, reminding folks that yes, there is this world where you can sell stock picks and provide research, but the other side of it being that it's almost impossible to beat the markets. And to your point, by the way, earlier, right? When people do beat the market, or if they do actually have something that they feel good about, it's either a hedge fund or they're not telling anybody. Because the last thing they want to do is have that sort of priced in.
No, you don't even know the Colonel's original recipe. You don't know the recipe to Coca-Cola for a clear reason, right? These are state secrets. Or the people, the late James Simons, who had the black box, who had it figured out. To be a member of that group where you can sustainably get, 25, 30%, those are absolute unicorns. But I guess in terms of animal spirits, there are people out there that want excitement in their stock market existence, that they want to be there. They want to be involved when things are hot. They want to be involved when things are painful. And to this point, Amro, you reacted to a post I had on LinkedIn last week, in that my last cover for the original Business Week was in October of 2009 on this gigantic flaming debate in 2009 is, were we going into the new normal? You might remember PIMCO saying that after this enormous stock market calamity and financial crisis of 2007 to 2009, I think peak to trough, it went down almost 60%. And a lot of people out there said, I'm done. I'm never trusting this again. That the market is going to be depression-like. We're going to have a long drought. Lo and behold, the past 15 years have averaged something like 15% a year. Had you invested $100, it would be more than $1,000. I remember at Business Week when that happened, people, because I was the markets person, older people than me, boomers, were tapping on the window saying, I'm liquidating my 401k. I'm getting out. Did not live. Your parents did not survive the depression. We're going to be eating cat food in no time at all. And yet everything told me as a student, even though I didn't want to be uppity and even though I didn't want to doubt their experience and their lived experiences, that's a very common term these days, I said, we're probably closer to a low, if anything else. And history has told us that it's an asymmetric bet in the United States. The Fed could throw unlimited amounts of money at it. The United States has reconstructed itself. Nobody had ever heard of NVIDIA back then. Long story short is that when it was painful, you had all of these people selling at the lows.
Yeah, I think there's two very important points that brings up, and these are things that will repeat in the coming years, or maybe even happen in recent years. But yeah, two things. One, the new normal argument was very compelling at the time. Anybody who heard this would tell you that, like, I am living this right now. I've watched the financial crisis happen.
Let's unpack that for a second. There are people saying that in the wake of subprime, we were living in a standard of living bubble, a credit bubble. You were spending above your means. Stock market valuations got way ahead. We're going to have to pay for this through a long famine, a long kind of 40 years in the desert, and don't count on stock market returns. That was kind of the gist of it.
Yeah, don't count on stock market returns. Don't count on an economy growing. Don't count on any kind of historical growth, because people were not going to borrow to finance, at least borrow to the degree they did in recent years, because they learned that when you are that leveraged, whether you're a business or you're a household or you're a single person, out of school, if you have too much debt, and if things get tight, you're closer to bankruptcy than just sort of trying to skirt by. So it was very compelling. You saw, if you didn't get laid off or if you didn't lose your job, you saw 10% of your company being laid off, and your friends were being laid off, and all these things. And so I think it was very compelling. But here's the thing: there's only so long that people are willing to, cut back before they realize, hey, I mean, this is sort of my interpretation of why things bounce back. Eventually people realize, wait a second, life was actually much more interesting when I was taking a very lavish vacation, or maybe, not necessarily excesses, but when I wasn't, pinching every penny, when I wasn't, only operating on cash and all of these things. I think people eventually realize that, like, you know what? A much more interesting life to take on a little bit of leverage and a little bit of risk. And it also, by the way, it doesn't happen overnight. It happens very slowly and gradually, right? Yes, after the financial crisis, the people, I mean, they're still not buying 6 houses or whatever, but slowly you get a taste of a little bit of credit card debt, or you see someone in your neighborhood, going back out and getting that auto loan, and you decide, well, hey, listen, maybe the economy is okay enough that, like, I can finance this stuff, and then before you know it, home prices are back to all-time highs, and all the companies in the market.
You do have to get a wretched case of norovirus from time to time to appreciate the good times, to purge the system. I'm sorry, nobody likes it. Everybody, does that moment, like, God, if you get me past this, I will never take for granted a sandwich or a salad or anything like that. But that chastening, right? And that's what that prophecy, we don't have to get into the jargon of recency bias. If everything was working, if everything was gung-ho into the turn of the century, everybody was approaching me and Henry Blodgett for tech stock picks and the like. By the time we had the lost decade of 2000 to 2009, everybody wanted to further and jump on this doom bandwagon. I remember Nouriel Roubini at Davos, the doctor, professor of doom. He had standing room audiences. Everybody wanted to hear that. But all of those doomsayers from that original crash, you think of Meredith Whitney, Nouriel Roubini, you think of the same guy with the glass eye who was in The Big Short, right? All these characters,
right.
They
Michael Burry and David Rosenberg,
and look at the crash of '87. Those very doomsayers are never right. They say a broken watch is always right twice a day. And those who are out there who is saying, all right, I'm getting an actual margin of safety here. When the stock market in March of 2009 was marked down to, in inflation adjusted terms, 1996 levels, you have to ask yourself, have we innovated past 1996? Are we really revisiting? It was truly a lost decade, but that's when the market is telling you it's safe to dip your toes back in. As Warren Buffett likes to say, is I'm greedy when others are fearful, and I'm fearful when others are greedy.
Yeah. And it's funny, like things like valuation metrics and, price earnings ratios and these things that help you understand what you're paying for when you pay a certain price for a stock. 90% of the time, you're hearing from people, not necessarily even doomsayers, but a lot of investment professionals will be out there saying, hey, these market price ratios, whether it's 19 times earnings or 20 times earnings or 17, this is way above the historical average, and this is not a great time to be investing. So here's the thing about with valuations, right? When they're elevated or above average, you always have people saying all these reasons why you don't want to be invested in the stock market, right? But to your point about the financial crisis and inflation adjusted prices going back to the 90s, this was also a time where price earnings ratios and valuations were extremely cheap. This is like once in a lifetime you see the opportunity to buy the stock market at 7 times earnings. But
and I will quote the late Tobias Lefkovich from Citigroup. He was a friend. I'm sure you worked with him. He said, "You buy when you don't want to." And that's a really hard discipline to hone. You have to lose money. You have to have survived loss. You had to have seen both FOMO and loss, right? The money that you lost as an individual investor, as a cub investor, while the markets were gaining money. That is a
Right.
chastening unto itself. And people had to sit on the sidelines long enough to see the market go up to say, you know what? I don't believe it. I don't believe it. Those who had stuck around, I remember the stat from Vanguard and Fidelity is on a total return basis, you had recovered to your pre-crisis levels, I think by 2012, 2013. So it brings to mind the old Jack Bogle of Vanguard truism. Don't just do something, sit there.
Yeah. I mean, Tobias Levkovich is, one of the goats of this business who would actually go out there and give you very clear thinking. He famously came up with this panic euphoria model, which would take all these measures reflecting panic. And when the panic was high, that's when you buy. But it's always when you feel worse about it that becomes a big buying opportunity. But it kind of makes sense when you think about it, right? When everyone's freaking out, when everyone's preaching stuff like the new normal, when everyone's preaching a world where you're not going to have great returns, that's actually the time when prices are going to be very depressed. And so, another way to think of it as an investor is you're getting a great discount. The more fear that's out there, the bigger the discount, the bigger the sale that's going on in the stock market. And if
but
those
that other
change,
metaphor you surely know is catching a falling knife. You only want to lift the knife once it hits the ground. And there's always that fear that something that's cheap could get lots cheaper and you could just be writing that down for a long time.
Yeah, but I think what you were saying previously about having experience and being able to stomach those losses and stuff. I mean, gosh, this is probably a terrible sort of analogy, but it's like with investing, it's better to invest and have some short-term losses than to never be invested, right? So it's like, and there's also all kinds of studies that will tell you things like, timing the market is extremely fraught and treacherous. But if you have a decent enough time horizon, whether markets feel high or low, you put money in, you might have some paper losses in, the next couple of months or next year. I mean, which is, by the way, historically normal. But the person sitting on the sideline is at higher risk of never having any of those gains. So yeah, like it's, all this speaks to the fact that this isn't easy. If it was easy, if it wasn't so emotionally fraught, the returns wouldn't be as good.
Well, volatility is the price of admission. Within that, and there's a sub theme here, and you kind of hinted at it earlier, it's kind of easier than it's ever been because think about when you came to the industry. Think about when I came to the industry. The brokerage commission really doesn't exist anymore. Right. If you open up an account of any of these major asset managements or brokerage firms, especially if you're young, you could start with very little monthly, quarterly amounts, and they're not docking you commissions. And the exchange traded funds, they've been in this price war for years. Entry, access to that, as opposed to back in the day, when I got my first taste of the stock market around my bar mitzvah, 37 years ago, you'd have to call a brokerage firm. If you're going to buy a mutual fund, you have to wire the money, call the 800 number, get print once a day. You didn't have 24/7 prints of things going on social media. Now it's really, for better, for worse, hopefully for better, it's more accessible and cut rate cheaper than it has ever been.
Yeah. People have mixed feelings about how accessible and how cheap that has become. But I generally sort of lean toward the optimistic side of things. I think it's really good when people can get an introduction into this world, even when they're not, super well educated, to get into this world and learn about sort of how market volatility happens. Now, you're either going to go, there's two paths you go when you first start on this. One, you're either going to lose money or underperform the markets, and eventually it sort of sticks that, this is what happens, and you have financial statements to back it up. You can't make up the history anymore or whatever. Or maybe you do get a couple of really great picks and you crush the market and, you try to keep going into that. But eventually that stuff catches up with you. And listen, every once in a while, there's going to be a 20-year-old, James Simons that comes out and, maybe he crushes it for the rest of his life. But what I'm saying is, it's better to get these educations while the stakes are relatively low than learning about it when you're, 20 years into your career and you actually have, tens of thousands of dollars or maybe even a couple $100,000 in a 401k plan where and
a family and other concerns and a mortgage and T-minus 12 years to kids going to college or whatever it is, where the stakes are much higher.
Exactly. I mean, the last thing you want to do is learn that most stock pickers underperform when you have kids and when you have to send someone to school, as opposed to when you come right out of school yourself.
Now, let me ask you, do you believe in the theoretical? I remember in business school, they would talk about what was the efficient frontier without getting into the wonky weeds. If you could, in theory, own a little piece of every asset on the planet, right, at a very low cost, I'm talking about not just S&P, but Europe, emerging markets, frontier markets, places like the Philippines, East Africa, if assuming they were liquid, assuming you didn't have to pay a ridiculous amount to buy them. I'm talking Hass avocados. I'm talking alpaca fur. I'm talking crypto, every possible risk asset that within it, things zig and zag. But over time, real estate, commercial real estate, precious metals, call it what you want, right? Coffee futures. Over time, that's the only free lunch in this, to own every asset in the world. In practice, that's impossible, and it would be cost prohibitive. So the best approximation we could have is like an all-in-one index fund that attempts to buy as many companies on the planet in as low price, like a one set it and forget it value meal stock. And that's actually possible right now. Do you, in theory, at least from what you've learned, do you still subscribe that that is the only free lunch in all of investing?
Yes and no. Here's how I would put it. I think first and foremost, the reason why any of these ideas work is because you start with an agreement that everybody wants things to be better, right? Everybody would rather have a nicer house than a worse house. People want to, take 2 vacations instead of 1 vacation. They want to be able to have a nicer birthday party for their kids rather than a crummy birthday party. And as long as this is the attitude, then you have a sort of a well-greased capitalist system in your economy to sort of enable that, to connect the entrepreneurs to the folks who are demanding whatever it is you're offering, then yeah, I think something like that could work. My preference has been to slant a little bit more toward the US than anything else, for a couple of reasons. And this is specifically in the context of investing in something like an S&P 500 index fund. First of all, you can get exposure to all those other economies and all those other markets through something like an S&P 500 index fund, because somewhere between 30 to 40% of business that's generated by these US companies comes from outside of the US. And I can promise you, these people are spending every effort to be in the best markets where they can grow their business activities. And so that's the first thing. So you don't have to own stocks and financial securities in overseas markets to get exposure to those economies. You can do that through, with US companies. And by the way, when you do buy stocks in those other economies, there's actually a pretty good chance, or, a greater chance, that you're going to get more exposure outside of those economies, right? Like, big companies in, France, or big companies in Germany, and big companies in Korea. When you invest in those stocks, you're not, just exposed to those economies. Those businesses that, make up those securities are doing a lot of exporting to places like the US and China and other places where they can drum up business. So that's the first thing. So it's not as, you can get the same geographic business exposure without going into those markets. The second thing too is, this is up for debate. There has been outperformance in the US stock market relative to a lot of the international markets for many years.
17 years, it's a long drought, because people forget during the lost decade, it was international that smoked us right after the dot-com crash. But international has done nothing, mostly since the financial crisis. It was resurgent this year before the Iran invasion, but some of that's been given back. But international has kind of been a lost art form.
Yeah, and I think there's a really strong fundamental story to back that up. When you do sort of look at the nature of how these businesses operate, it is actually the case that US companies actually have the highest profit margins in the world. And US companies have also had the best earnings growth in the world for, the last decade or two. And I don't think this is just
Sam, you're paying for that, whether or not you subscribe to the whole PE, price to earnings, price to sale, cyclically adjusted price. And again, we're a public radio show. I can't get into those weeds, but hold that thought and do stay with us. We're joined by Sam Rowe of TKer. Full disclosure, stay with us. Full disclosure airs on YouTube, NPR, Spotify, Apple, all of the fine podcatchers. features. I've put them at one neat link for you, fulldradio.com. Again, fulldradio.com. A shout out to our radio listeners on WVTF, Radio IQ, Virginia's NPR news station across the great Commonwealth. We are down in Asheville, North Carolina on WPVM. We are out west in Ventura, California on KPPQ. Holler if you too would like us on your air, and watch me every week on both CNN and NPR. My DMs are always open, so just holler. If you're just joining us, my esteemed guest is Sam Rowe. We're meeting each other for the first time after it's been a mutual admiration society over LinkedIn and social media for the better part of 20 years. Sam Rowe is the founder of TKer. This is his long-term investing newsletter. He is a veteran of Forbes, Business Insider. Gosh, you've been at Axios, Yahoo Finance. Sir, you are well traveled. And you started off, as you were explaining earlier in the show, being a kind of a widget grunt at Paul Weiss, which is a major Wall Street related law firm. But you did a tour at Brown Brothers Harriman, which is very venerable. I'm going to throw up a jump ball at you. What is crypto? Baby, don't hurt me. Baby, don't hurt me no more.
I honestly
what is
don't
it?
know.
No one has been able to explain it to me.
I don't know. So here's how I think of a lot of the things I see in the world, whether it's financial markets, the economy, or whatever. You can tell me it's one thing, but whatever you tell me it is, I need to be able to see an echo of that in the other side of the world. Okay, so there's basically sort of two different narratives that I keep hearing about crypto. One, it's this technology that's going to enable all these financial transactions and make everything cheaper and more efficient and blah, 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 blah. And then two, it's something that criminals use to extort people or make financial transactions, that go unnoticed. My view is I'm basically agnostic to this world. I wouldn't be someone who would recommend buying into this in terms of buying crypto, because until there's maybe something that makes a little bit more sense to me. But to that initial point, I think that if it is the case that the crypto evangelists are right, and it is going to grease the wheels of the financial systems and make transactions and all of these things much more efficient, then it should actually come back to us in the form of returns and other parts of the economy and the financial markets. If it is going to change the world, as everyone says, then just be invested in the same investments you have in the stock market, because they should certainly benefit indirectly. Someone has to actually explain to me, who is actually using this, because it just seems to be the crypto evangelist. So it gets to the second issue of, this criminal element. Like I said, I need to see how it operating in the real world for me to be convinced of these stories. And something that I see every day, I get text messages every day from spammers, and I get emails every day from spammers. And I turn on the news, the evening news, and every couple of days, someone's being extorted and being asked to be paid in crypto. I just read a story this morning about, I don't know if this is true, but this was reported that countries are paying Iran to send ships through the Strait of Hormuz. And, one of the forms of payment that's being accepted is crypto, so that you don't have to have a whole paper trail.
Hormuz coin. What have
Hormuz coin. That's a big opportunity. Now, I hate to say it, but everything that has been said in terms of it being used for illicit purposes. And listen, I also know that there's a case to be made that, good people are also using crypto to make transactions in places that are, fraught and corrupt, and where you would get persecuted for trying to use money to get aid into your country and stuff like that. I understand that. But I think the only thing that I really understand in terms of the value proposition is being able to make transactions that are hard to trace. So yeah, that's really all I have to say.
Adjacent to this, Sam, gold, which had a banner 2025. People are worried about debasement and prices and the like. It's always been a Rorschach. You could talk to people in India or fellow Iranian Americans and various others. It's this ancient currency. There's only so much of it that was ever made. Its practical uses maybe for fillings or for drill bits. When you're approached and said, must I buy gold? Or is your mind saying that, whatever the S&P 500 has in miners and precious metals exposure is sufficient?
Yeah, I tend to lean toward the latter, but I feel like the more people I talk to, the more I understand the appeal of gold. In that, there's a lot of people who think that believe that there's value in it. And there's a long history of it too. And, people like Warren Buffett and others will, talk about how there's not a lot of intrinsic value in gold outside of it being a shiny object that has, a finite supply. But
They could say the same thing about NFTs, which were briefly very valuable in 2001 and 2021 and 2022.
Yeah, and these are sort of and NFT is another example of like something that is the purest form of this intangible value that is just based off of a belief system. But it's not too different from the premium people pay for getting your coffee at Starbucks as opposed to making it at home, right? Like how different is the value from gold from the intangible value you get from paying $4 for a cup of coffee as opposed to 50 cents?
I'll say this: there are people out there. I mean, who's the blowhard who's always been a nice guy, but he blows really hard talking about gold, and will only price things like, oh, BS that you're quoting $4 gasoline. What is it in terms of gold? What is it in terms of gold before we depeg the dollar to gold in 71? There are all these gold bugs out there that say it's the only truth. It's the only common denominator to all of this. That's the only thing that you could trust in a time of a Federal Reserve printing left and right, especially if Donald Trump is going to really politicize the next Fed chair, that this is the only way you can inoculate yourself from junk fiat currencies. After all, since it debuted, didn't it go from a couple of cents, crypto, Bitcoin, to more than $100,000? I mean, that's never been seen before in a decade.
Yeah, I mean, listen, at the end of the day, if enough people believe something, particularly in the context of financial markets, if enough people believe something, then that's the truth. I think it's really that simple. Again, very different from things like, equity securities and fixed income securities that are actually tied to cash flows and rights of ownerships to something that's tangible. But yeah, I just think it's very difficult to assign a value or at least a stable value to something like, precious metals that don't have a lot of industrial uses, or cryptocurrencies that don't have a lot of, real world applications outside of stuff that's, people don't want to talk about.
Full disclosure on Roben Farzad, we're joined by Sam Rowe of TKer. He founded TKer in 2021. I mean, fresh in the pandemic. He's a veteran markets and financial reporter. He was, of course, at Forbes, at Axios, at Yahoo Finance, at Business Insider. And I don't want to embarrass you, but one of your great candid posts in 2013, I believe, was your ordeal with Bell's palsy, was waking up one morning and looking in the mirror, and it's this very Kafka-esque moment. Like half your face wouldn't move. Oh crap, did I have a stroke? I Google it. No, it could be a much more mundane Bell's palsy. We all know somebody who's had it. You don't feel like you feel half your face, but you can't move your eyes. You can't move your lips. You were very candid about it. You posted it online, and I guess it's okay because you're not there anymore. I can joke. Wow, this we've read about it. It happens to men in foxholes before they're about to go off to war or invade other people, like a time of peak anxiety. I thought, man, Business Insider must have been a major sweatshop.
Well, it was at the time there was a lot of publish first, then think about it later kind of a thing. But it was a very easy personal story for me to share. Like there wasn't any pressure for me to share that story outside of the fact that like I thought it was an interesting experience. So
do you think it was stress induced?
Do you think
you were doing too much? Because who is that guy? He's now at Bloomberg. He's like, he's up at 4 a.m. What did
Joe
I miss?
Weisenthal.
That's a terrible benchmark to set. What did I miss?
I mean, Joe has talked about it on his podcast appearances before, where it was an incredibly stressful time. I will fully acknowledge it was an unbelievably stressful time. Was it stress induced? I'm not sure. Maybe it was. But yeah, it was a really kind of a scary thing to wake up one day. Let me tell you that, first of all, thanks for having remembered that story. That's good evidence that like we do actually go back. But here's the thing that was so striking about it. So I wake up, it's like a normal day of work. I take a shower, and the next thing I have soap in my eye. And I'm like, oh gosh, I can't believe that this is like the first time I got soap in my eye since I was like in kindergarten. Like, what am I even thinking? And then I'm looking at the mirror, and the mirror, it was acting up. And the first thought I had in my head was the mirror was broken. Like I thought that I was living in some sort of like haunted house. Like, this is how.
It's so richly metaphorical and everything. I'm not broken. The mirror is broken.
Yeah, I mean, maybe I learned something about myself in that moment. Is that like a survival instinct thing or something? And then the next thing I know, half of my face just wasn't moving. And of course, now I'm freaking out because I thought I was having a stroke. And thank goodness Google exists. I Googled this, and the first thing that they say is, if you're asking this question right now, then it means you're not having a stroke. But yeah, I saw a doctor and it was Bell's palsy, and I had it for a couple of weeks, and then it cleared up. I will say here's this is sort of neither here nor there. One thing I did appreciate about that experience was, I ended up, it's not like a super debilitating illness. It's, I mean, obviously it's very visible, but I was going out. I went to a ball game. I went to some happy hours and stuff. And I was shocked at how many people would just walk up to me and say, "Hey, I've had this. You have Bell's palsy. I've had it too. This is going to work out." Or I remember very specifically, I actually took a day off and went to the MoMA. And, I was about to pay full price for a ticket to walk around the museum. And the guy selling me the ticket says, "Hey, I noticed, that half of your face isn't moving. I've actually recovered from Bell's palsy." And he gave me student rate. So
I'm a student of life. I'm a student of temporary paralysis. You can't really laugh at that, but that is a memorable byline from some guy who speaks my language, who speaks sell side, buy side, CAPE ratios and everything. That was of that era where if this happens, I'm sure you pinged Yarrow and Wiesenthal and Blodgett that morning. He's like, "I gotta tell a story." And they're like, "Kid, why don't you just relax in the ER?" But I wanted to do that by way of introduction of your kind of emancipation moment and launching TKer, right? As you've known, a through line in this show has been the inexorable fragmentation of media. We all used to be so wedded to bylines and back offices. If you think about Forbes and Axios and the New York Times, personally at Business Week, you will not imagine. You go back and look up the story of the late Jean Marcial, who used to write the column in the back of Business Week. And it was so protected, his stock picks, which he himself would tell you that just a handful of people on the street would give him stock picks, that a special copy editor would carry them around in a red envelope to make sure that it didn't leak. Because once this printing press in Milwaukee gave advance note, can you imagine a weekly magazine, stock tips, and fronting the market? But that shows you how far we've come. You now have your own operation. I don't know what the genesis of it was. I don't know if, when the pandemic happened, and if you have nothing to lose at this point, if we're all unemployed, tell me about starting that. Tell me about the moment when you said, "You know what, I'm off on my own and I have enough of a following that I can deliver my own alpha."
Yeah, well, by the way, I remember that Business Week story. That was incredible. I think was it Adidas that was written about?
I don't know. He's sat next to me and I love him. The great Filipino stock picker. "Hey, Roben," this is what he would say. And I'm not Gene. I love you. The dearly departed Gene Marcial passed away years ago. Sat right next to me. He's like, "Roben, the only money you can make is in New York City real estate." Hey, dude, you're telling the world to buy stocks, and you're telling at the same time he was a major, Park Avenue real estate mogul. So
yeah.
That was a different era. We actually cared and coveted what was in Business Week's print issue. I don't even know if there's a Business Week print issue, but take us back to you and TKer.
Yep. Yeah. So this was something I was thinking about over time, and it was born out of feedback that I was getting from readers, whether it was people who were reading specific things I was writing about or stories that I would assign to other reporters on my team, where we might have been cranking out, dozens of stories every day that's, very market news related. But, within that mix was a lot of stuff that had sort of a long-term orientation. Yes, this is the news of the day. This is why markets might be moving today. But here's information about the historical analogs. Here's information about something that you're not seeing in the headline, or et cetera. And I remember just continuously getting this feedback from people for those particular stories. And by the way, we had analytics in front of us, so we knew exactly what stories were clicking and what stories weren't clicking. And I noticed that there were a lot of these stories that weren't high traffic articles, but would always get this really high quality feedback. So, basically for me, the opportunity was, I felt like there was an audience that was being underserved, right? Someone who is a little bit more conscious of the fact that they're investments, their 401k plan, their 529 plan, they don't have to make changes based off of what's happening today or what happened yesterday. So maybe there's a world where I can write about news, I can write about stats, I can write about a lot of the same things that everyone else is talking about in the news, but I'm going to frame it for someone who has a couple of years of time horizon. And so that was the big opportunity for me. And it's the kind of thing that you can pitch at a bigger publication, but having worked in management, I know that stuff like that only lasts so long because you have to have growth into perpetuity. And I knew that there's not going to be 100 million people interested in this. But maybe there's a couple thousand, or maybe there's 100,000, or maybe there's some niche that's just not finding their needs met at some of these bigger publications. And so that was the genesis of the idea. It went way back, and then you hear about platforms like Substack, which I'm currently on, which helped reduce a lot of the administrative frictions for writers. Everything from building a website to having a word processing tool that works, to having a payment system that makes things efficient that you can plug into your QuickBooks and then it does all your taxes for you. And not to mention the direction of the industry, which appeared to be getting much more fragmented as the economics of business media have become less friendly.
By way of that, how do you convince everybody, and I'm sure you're asked this at cocktail parties or pickleball sessions, whatever it is the young people do these days, there's so much login fatigue. I mean, Netflix just hiked us again, not that you're in the same boat as Netflix, but when everybody has to look at their outlays in a la carte media and journalism consumption industry. I'm paying so much for the Wall Street Journal. Bloomberg is hitting me up against the paywall. Business Insider has been off and on a paywall. And there are many other scribes out there, people directly from the sell side, people in VC. How do you make that case to people that, look, I'll give you a taste for free, but you want to sustainably help me make this a living?
Yeah. Okay. So I'm going to tell you one of my trade secrets, and please don't share this with everybody. I don't want everyone to know how this stuff works. I'm joking. No one's going to copy this because it's way too risky. But here's something I know, and it's one of the most counterintuitive things in all of media, especially in paid subscription news or paid subscription information. No one will ever complain about not receiving enough content, right? So the way my publishing schedule works is, okay, I know people do want some kind of a cadence. So I do send out a free newsletter every Sunday and to satisfy people who have that specific need. But my paid subscription includes a couple more newsletters. It's usually somewhere between 1 to 3 additional pieces that I publish during the week, depending on the flow of news, depending on if there's an interesting stat or an interesting piece of research that someone has sent me. If I don't think it's interesting or valuable or worth my time, then it's probably not worth the reader's time. And so maybe there will be weeks that go by where paid subscribers will not receive something during the week. And I've got confirmation that no one will unsubscribe if you don't send them stuff. Now,
it reminds me, and you probably remember this, the Outstanding Investing newsletter. I don't even know if it exists anymore. It was this very rare, only when issued thing that value investors would read. It only came out in print or very secure PDF, right, and was $1,500 a year or something. And you take it or you leave it.
Well, so the challenge, of course, is to develop that relationship with your audience, to know that when you do send something that you believe it's worth their time right now, or you believe it's something that they should have in their inbox for the next couple of days because there's a reason why I sent you one thing in the last 2 weeks. And there are a couple of analysts and there are some publishers who are on this extremely informal ad hoc schedule. Like, I mean, like if Stephen King was publishing a book at the same date every 6 months, it'd be a completely different experience versus, the unpredictable timing of when these authors publish because, a book has to be good before it goes out, right?
Let me ask, and to get to the full disclosure brass tacks, are you making a living on this 5 years into this experiment?
I am. Well, I expected this to last about 2 years before I would have to pull the plug. The short answer is I am a little bit below where I need to be to make this sustainable, but I am above my target in terms of being able to continue financing this in a way that I can give it more time to reach that level I'm hoping for.
It sounds like Wall Street sell side speak, like medium, maintain, underperform.
I'll put it this way, and I want to make this very crystal clear to people who are even thinking about, leaving a stable career to pursue this. This is not like, this is like picking a winning stock, right? The odds are stacked against you, and this is extremely challenging. The part of the reason why I'm able to even, stay alive here is because my costs are extremely low. I'm pretty cheap guy. And, I work with a couple of contractors, with editing, but, I'm also the head of my IT. I'm also the head of HR. I am responsible for all the accounting. If my computer goes down, I'm screwed unless, I figure that stuff out. I was just telling you before this, I had to go out and shop for my own, mic to do this. It's like, I'm doing the research. I don't have, an audio visual guy, helping me with that.
But you are waking up with both sides of your face, which is a great payback.
Yeah. And well, I mean, to that point, that's exactly it. The work-life balance has never been better. I think my best work is coming out right now because of the nature of reduced work frictions. If you want to read between those lines. I've even lost a decent amount of weight since leaving the full-time news business. So, it's not just about, a P&L, but I think the economic value has been extraordinary going independent. So, yeah, if people are interested in pursuing this, I'm happy to, chat with them. I talk to a lot of people, by the way, who are considering this lifestyle, and some of them very quickly realize it's not for them, and then some of them decide, hey, wait a second, this is actually solving a lot of my problems.
Sam Rowe of TKer, consider yourself a friend of Full Disclosure. You should put that all the way at the top of your LinkedIn. We should give you a friend of Full Disclosure button. And you know what? Just to toot my own horn, you listener out there were listening to me effectively meeting Sam Rowe, somebody I admired from afar, a byline I've always loved. And I said, finally got to have you on the show. We've been chasing each other on LinkedIn and the like, but I love what you're doing, and keep at it, and come back on whenever you want.
I'm around, and I appreciate the compliments. I'm glad we did this. And yeah, I don't know if there's anybody else who I'm meeting for the first time who's been spoken so positively by many, many strangers. Roben, people are talking positively about you behind your back. And, hopefully some of that good grace is getting to you.
My friends like to say it wouldn't be a party without a Sephardi. Sam Rowe, come back on.
Will do.
Full disclosure, special thanks to Ian Stewart. If you are listening to us on the radio, note that while we cut for broadcast link, the entirety of every interview is on podcast. We are on the NPR network, Spotify, Apple. Watch us on YouTube. You could find them all at one link, fulldradio.com. Again, fulldradio.com. And please do recommend us to a friend. A shout out to our home station, WVTF Radio IQ, Virginia's NPR news source. DM me to carry us on your air, and catch me every week on both CNN and NPR's Here and Now. I'm Roben Farzad. Thank you for listening. Back with you next week.